Hello, Matt. Welcome to our next episode of our Going Live with Good Soil weekly live stream, just to talk about all things Tesla, especially macro markets are always related to Tesla, as we know and see today, especially. So, just for everyone on Twitter Spaces, we're also doing this on YouTube Live. We've been doing it weekly on YouTube Live, and we figured out a way to also put it on Twitter Spaces at the same time, just to capture a wider audience that isn't subscribed to our YouTube channel, for example. So. This is not financial advice. None of this. This is all just our own thoughts and opinions on things. We're not investment advisors. We're not registered investment advisors, at least, and we're not trying to tell anyone how to invest their money. So, with that, I guess the macro markets. Matt, first of all, I think you just got off a chat with Dave Lee, and that probably will be released, I would imagine, later today or something. And I'm excited to see that. He probably picked your brain on accounting and such, right?
Yeah, less so on accounting, but I think he's been doing a series of interviews with different kind of Tesla Twitter analysts and folks out there, trying to make sense of the crazy delivery numbers that we just saw from Tesla. So I'm sure we'll go into that in a minute here on this episode. But yeah, Dave's been doing a lot of great content around that. So we spent some time kind of digesting what that means for Q4 results, but then also kind of extrapolating forward. What does that mean for 2022 deliveries, and then how does that translate to earnings per share, and then how does that translate to share price implications at a given PE multiple? And so there's the thing I said to him is that the implications are quite drastic, and that's I think that's true. We'll see when the earnings come in and over time how the stock price reacts to this and then subsequent quarters. But I do think this is a bit of a watershed moment that'll be fun to kind of track over time.
Yeah, I think so too. I mean, this is one of those kind of stepping stones, I think we'll look back at and remember, as one of those pivotal points. Last quarter's gross margins felt sort of like one of those stepping stones where, it was really a surprise to most. And I think this quarter, this really surprise production and delivery number, which is even above like the largest bull's expectations. I think the largest bull was like basically Troy Tesla, like at the very end, like rising his expectations to 299,000. That was like the highest I saw. Is like people who actually seriously were putting estimates. Everyone else serious estimates was putting 260 to 290,000, that kind of range. But 310,000 practically, 308,000 or whatever. They really knocked it out of the ballpark, and Giga Shanghai really, I think just tore through everyone's expectations, and it's incredible just to see how successful they are now manufacturing. I mean, for years, Elon would say manufacturing is Tesla's strength, but it actually is now. It's great to see. So, kind of before we get into Tesla too much, though, let's talk about the macro market, because right now, this minute, everyone who's long Tesla is a little, it's been a roller coaster ride. Up $140 yesterday, down $40 at the moment. So we've come back a little bit, but it was down like $70 not long ago or something. We're at 1158 as we're talking right now, and it just seemed like 12 hours ago. I feel like I went to bed or something, and was thinking, oh well, I think we'll hit all-time highs tomorrow. Because it was up $10 after market, and I was like, all right, well, the futures look okay. I went to bed sleeping like futures look fine, flat, and I think the buying will continue. And then this morning, bam, the market opens, and the whole macro, the growth stocks and tech stocks, I should say, the sandbox we play, it should really have its own index at some point soon, not just like the NASDAQ. It should be like the growth stock index or disruptive stock index. I guess you can call it the ARC, flagship ETF maybe, but they've all been hit so hard. What do you think about this, Matt?
Yeah, it's not surprised. I mean, I kind of think you and I have been talking a lot about like the macro market, and there are, I think, legitimate risks in the macro market, probably especially with inflation, getting away, and the potential for rate hikes, which will disproportionately hurt growth stocks. I think that risk is still out there. What you and I think, have been trying to do in the last month or two is to say, all right, well, which companies have the fundamentals to outperform it regardless of the macro environment? It's very hard to kind of buy short-term puts or something like that and kind of bet on a market correction downward like this, or or to sell off your core positions and just keep cash on the table. Like you can do those things to kind of de-risk. But I think it is very difficult to time those things, and at least for me, I'm not convinced that that would be the right move to try to time a crash. Especially when a lot of the companies that we're looking at just have really improving fundamentals. So that's why I like to have just a small group of companies that we feel very strongly about, that can perform kind of regardless of what the macro environment is doing. But what's your
Yeah.
take on that this environment? Because clearly this is macro driving Tesla down today. It's not like Elon selling
Mhm.
again,
Yeah.
an undoing of like the great gains yesterday. This seems very clearly to be related to macro.
Yeah, all our stock. I mean, Roblox has been hit hard, even Lemonade and Rocket Lab, the other stocks we talk about, but like we're in the growth stock sandbox and they're all going to get hit hard in these events where you have like more inflation, expectation fears. I think that's the story of 2022. I don't think COVID is the story of driving macro markets anymore. I think it's going to be, is inflation here or is it not? Is it going to be transitory or is it going to be here to stay? Like how are we going to handle inflation? And I just think the headlines will exacerbate maximum fear. That's what their job is. If you're a business, your purpose is to make money, and all of the you know firms generating headlines are businesses, and their purposes are to make money in different ways and shapes and such. So advertising, clickbait. So they're going to maximize fear because that maximizes clicks. And the way to maximize fear in the markets is, I think, really talk up inflation. There is some inflation, and I do believe myself that it is ultimately transitory to a large degree. And I think it'll stick around. It won't be this high forever. Hopefully, when supply chains ease up and such, in a few months or a couple quarters, hopefully by then we'll see. But macro markets are impossible to predict, but I think the market's going to have these jitters every few weeks or maybe every month or two. We'll have like some kind of inflation scare that drops all the growth tech stocks 5 to 10% real quick in a day or two. And it'll be a nice buying opportunity. Like tomorrow could continue for another like big drop in growth in tech stocks. Though you don't know if it's just a 1 day or 2 day or a week event. But I think that's going to be the theme of 2022, is maybe for a lot of maybe the next few years even. I don't know. But every month or two, you'll see like a quick pullback, and then you'll just melt up after that, for the next month or two to new all-time highs, and a quick pullback, and then you melt up, and it's going to be like, 2 steps backwards, 3 steps forward, kind of thing. And it's just going to be very hard to stomach, if you're buying near the top, if you get the FOMO and you buy Tesla when it was at 1,200 yesterday, and now all of a sudden you're down, in the morning X% right off the bat, it's going to hurt, so it's a roller coaster. And I just think that's going to continue, and that's fine. That's how the markets are supposed to be. So that's just my big picture hunch. We'll see.
Yeah, I tend to agree with you. I mean, it's the markets are so jittery right now. I mean, we've seen this last 2 months with like these kind of strong rallies and then like panic selling, and it's
Yeah,
like you've had like a kind of steady stream of days where the whole market's up like a percent or a 0.5% a day, and then it's like down 3% all at once. And so
yeah,
I think this sort of uncertainty will continue. But like we've been saying for a while, I do think there's a decent amount of cash kind of sitting on the sidelines, because people, institutions in particular, don't want to invest in a lot of like high risk stocks, when the VIX is so high, and when
yeah.
there's so much uncertainty. So there's the traditional thought would be that will flow into corporate debt, as is like the markets, ebb and flow. But yeah, I just don't think that's gonna the interest rates being as low as they are right now. I don't think that kind of traditional flight to safety is going to make as much sense in the current environment as it maybe did 15 years ago and
Hmm.
previously.
Yeah, absolutely. So yeah, I think we'll see what happens. But yeah, I mean, I'm very confident in Tesla still. I mean, I think we should be at new all-time highs based on the production and delivery numbers. So the market will do what it does in its time frame. I'm not I can't dictate that, but I would not be surprised at all if we're at new all-time highs still later this week, if this correction right now is just a one-day thing like today, for example. I think there's a lot of institutions out there that want to get a piece of Tesla after this production delivery. It's like, their analysts or whoever they've been listening to, they're finally like, oh, let's just get into Tesla now because we don't want to miss the biggest story of, the decade, and there's been doubts, but this is just another number, this production number and delivery number that is really, it's substantive evidence that, what you believe is it needs to be updated. What anyone who's been a skeptic of Tesla, whatever they believe for that skepticism, they really need to, if they can be convinced by actual data, then this is the data, exact data that I think could help convince that skepticism to kind of turn into like maybe Tesla is the real deal.
Well, I would say even for Tesla bulls, it kind of forced a reevaluation. Like you and I
Mhm.
were, what was it, 3 weeks ago, I think, walked through, the model that I had there, and I think I was projecting like 220 in earnings per share for Q4.
Yeah.
But after that delivery report, it's like, okay, I'd go back and reevaluate a lot of different, assumptions that I had in there. And, I think you were around 290 with all the assumptions that you put in, which
I think
at the time
296.
seemed
I put in some like
296.
real, what I thought was
Is that
realistic but optimistic. But yeah, 296. Yeah, maybe that's even low. Yeah.
that's funny because I was just updating my model, and I came up with 295 as like my middle of the road estimate for
Hmm.
Q4, given this new piece of information. And then from there, yeah, and this is a lot of what I spoke about with Dave. So anyone who's curious, watch out for that Dave Lee interview that'll be dropping pretty soon. But like the prudent thing to do then is to go forward into 2022 and say, okay, well, what does that imply for deliveries in 2022? And if you are delivering more cars, but your fixed costs and your factory costs in particular aren't increasing, one to one with your units sold, then you're going to have some gross margin expansion, especially when you consider the price increases that have come through. So you start going through the first principles buildup of projections based on this one piece of new data, and it's like all of a sudden 2022 earnings look ridiculous.
Hmm.
And so like if you apply even like a simple PE ratio to like a reasonable 2022 earnings per share, or like, you can do a single quarter annualized and apply PE multiple to that, like we've talked about, or do a forward
Yeah.
multiple. It's like very difficult to imagine a scenario, even in a deteriorating macro environment, where Tesla doesn't go up from here based on kind of the expected operational performance that I think they're going to post. Not financial advice, and I wouldn't recommend trading on that, but just running through the numbers, it's like it warrants a reevaluation of everyone's kind of share price targets.
Yeah.
I
Yeah.
think.
I agree. I agree. And I think the stock will perform well relative to the other growth tech stocks. It doesn't mean that the stock is going to go up though, in my opinion. Like if we have this kind of growth stock, if it's much choppier than I even expect in terms of growth in tech stocks, like getting hit hard from inflation fears, like you could be, the business of Tesla is booming, right? But the stock itself might just like hover around like 1,000 to 1,200 or something. You can't, like buying call options straight up because the
Yeah.
business is booming is not a necessarily, is not close to a guarantee. It's not even close. It's like maybe it's probable. I don't know, but maybe it's not. It's almost like a coin flip, and I think in the past you could buy on Tesla when it was really like breaking new ground, and it felt like you could buy the call options and have a high chance of doing well. But in this type of weird macro market environment we're in, I'm not so sure it's the case. So there's a lot of people buying tons of call options at Tesla out there. It's like by far the most call option traded stock, like 10 times more than Apple. And like I think like I saw some stat recently, like a third of all the call option buying in the market was like Tesla related. So there's a lot of gamblers and buying and doing things with call options in particular. I mean, put options to a little bit, but mostly people are buying call options. Maybe some people selling call options, but it creates incredible volatility and people trying to get rich quick. And, maybe there's a small opportunity in there here and there, but it's you really got to be ready to lose it all or double or triple or quadruple or whatever. You could really, it's really close to gambling doing like the medium or short-term call options, especially with Tesla in this kind of environment. But some people want to do that, so it's definitely risky. So just beware. The stock, I think, is very safe. I think at least it hovers where it is, and because the business is so incredible and it's really breaking expectations. But if the whole macro market and growth stocks are going down, that doesn't mean the stock's going to go up. It just might mean it just kind of hovers around where it is. So, and the call options would get killed in that case if you're buying call options. So just beware. I would say that's why we're not so, we're a little careful with how we play these Tesla movements, I think, ourselves. I mean, we do definitely do some options around it, but we don't bet the house on it. That's for sure.
No, definitely not.
Yeah.
Yeah,
Yeah.
you've got to be willing to, especially if you're doing something short term, you've got to be willing to lose it all or to close it
Yeah.
out and get to a spot where you don't want to lose, say, 50% of it, put a stop order in, something like that.
Yeah. 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 So the earnings price per share revisions, you kind of just went over some of that. Did you kind of go over that in detail with Dave on your chat? Should we wait for that, or do you want to show us anything here in terms of that? Or
Excuse me. Yeah. So I didn't share my model. I'm happy to kind of go over that here.
yeah, let's do that. Let's pull that up here then and see the
So
update.
here we
If you
go.
can, we can update some
Yeah.
inputs and see what happens. All right,
Can
I see it
you
now.
see that now? All right. So
Yep. And
for
for those of us
anyone,
on Twitter Spaces, yeah, it's on YouTube Live channel right now, being displayed. His model. You can watch it later. It's being recorded. It'll be posted immediately when we're done, if you want. But we'll try to talk through it too. So if you're just listening, you should hopefully have a good understanding.
So I have I have 2022 over here too. So just so people can see some of the projections. But basically, the only couple changes we can walk through from what we did previously was obviously just updating the total deliveries with the actual numbers from the report in here. I did not make any adjustments to the full self-driving take rate at 17%. I did have a little bit of a back and forth with Dave, though. He thinks that 17% might be on the high side. And so if that's true, then my kind of rebuttal to that is the core manufacturing gross margin that I've been assuming is accordingly too low. Because what I do each quarter, I think I've talked about this in the past, is I make estimates of full self-driving take rate and the amount that's recognizable, and kind of get the math to work out such that the gross margins tie to the actuals with given assumptions on take rate and the
So you
amount
reverse
that's
engineer
deferred.
it.
Exactly. Yeah.
So
So
that's where the
I
17%
reversed.
comes from. Just
Yeah.
kind
So
of
here,
reverse engineering the past quarters.
let me show some of the past quarters here just
Okay.
to kind of show you how this works. So like, obviously Tesla doesn't disclose the full self-driving take rate, but given a certain
Yes.
number of deliveries and a certain, revenue number and gross margin number, I have to adjust the core manufacturing gross margin and the full self-driving, the amount that's deferred, and the full self-driving take rate, in order to make sure that the revenue ties to the actuals and the gross margin ties to the actuals. So when I did that for Q3, I got an implied take rate of 18% globally for full self-driving, and a core manufacturing gross margin of 26.7%. So my point is, maybe I'm too high on full self-driving take rate, but that would mean that I'm too low here on the core manufacturing gross margin, such that the total gross margin doesn't change from the actual results.
I see.
So it's possible that maybe it's 13% full self-driving take rate, something like that, but it shouldn't really matter materially since it kind of comes out in the wash. But anyway, back to Q4. So that's this column right here. Sorry, we're kind of jumping around a little bit. So total automotive revenue of 14.7 billion. So like a almost $3.5 billion increase over Q3, which is just nuts. It's like and almost double what Q1 of this past year was. Like this is like insane growth that people were not really expecting. So after thinking about the credits too, I think I decided to go with what you were saying on 600 million. I do think it's more likely than not that there's been some sort of buildup of these credits. So I think we're kind of due for a larger amount, but it doesn't drastically change the story if that's say 300 million instead of 600 million. So adding all this together, 17.4 billion in revenue. I adjusted the gross margin up a little bit too. And the rationale. So I had this at going from 26.7%. This is the core manufacturing gross margin. So just how profitable are Shanghai and Fremont at making cars if you take out
Without the
full
credits.
self-driving and credits. Yep.
Okay.
Um,
And full self-driving. Okay.
and full self-driving. So, I had assumed that would be 28.7 when we did this last time around. So 2% increase, primarily just related to the price increases that I think are going to drop through this quarter. So if you think of like a $1,000 average price increase, at least gross margin, there's going to be a little bit of increased cost, but $1,000 on average, that equates to about a 2% improvement in gross margin. But with the beat on deliveries being so high, there's going to be better fixed cost absorption from the manufacturing facilities. So you don't need one for one increase in headcount or in machinery, for example. When you increase that, so there should be better gross margins just on the fact that you're producing more cars at the same facilities. So increase that from 28.7 to 29.2 in this latest revision.
Okay.
I won't go over everything else at all, but in total, but that gets to automotive gross margin of 34.7%. And then let's just jump to the bottom line. Adjusted earnings per share of $2.95, which is like pretty much right where you were before, that I thought was crazy high.
Yeah, $3 around that. Yeah, that's insane. Yeah, I mean $3 a share. That's what's going on.
I was going to say we talk about some simple math, being just annualize that number, and then what are we trading at now? Like what is it, 1150? So if you take 1150 over the annualized earnings that I'm expecting based on these numbers, it's a PE ratio right now of only 97.
Wow.
So that's where I think you start talking about like a backstop of valuation. And then if you kind of carry this math forward, especially into Q4, maybe my Q4 might be a little too high. I might want to revise that down. But like by the second half of next year, if the share price remains unchanged, then you're at a PE ratio of around 50. And the PEG ratio would just not make sense at that point. So that's where I think there's reasonable probability for some kind of movement in the share price based on those sorts of numbers.
And Amazon has a PE of 65 or something like that, right? I mean, that's crazy. So Tesla's going to have a lower PE than Amazon pretty soon. That's nuts. Maybe.
Yeah. And a comparable earnings. So this is one of the things we talked about. I think you and I spoke about this yesterday, Emmet, and I spoke on Dave's show. Like Amazon has very similar level of expected net income in Q4 of 2021 that Tesla has. So for the current quarter, like Amazon and Tesla are going to have about the same earnings. But Amazon's trading at 1.7 trillion and Tesla's at 1.1. And I would argue, like Tesla should have a higher PE ratio given their growth prospects.
Yeah, they're growing at a 50% plus per year rate. And Amazon, what's that, like 30% a year, maybe 20% at this point? I don't know. It's slowing down. It can't grow that much faster.
Certainly lower. Yeah. Like, you look at how much revenue goes into producing, 2.4, 2 point, whatever their net income is. They can't scale that, say, 100x from here, whereas Tesla can. Certainly 10x and possibly 100x. And then, if you think about the operating leverage and what that would do, like the PE ratio should just clearly be higher for Tesla.
Yeah.
So that's where, if they actually do come through with numbers close to, what I'm thinking they will, like the market's going to have some reckoning to do. Like you can keep being skeptical, but at some point, the money's going to move in, I think.
Yeah, I'm just looking at the intraday charts right now, and while the growth tech stock index, we'll call it ARKK, that's kind of near the lows of the day. It bounced up like a tiny bit. Tesla is actually rebounding pretty strong from its lows of the day. It's almost retraced almost half of how much it fell. I don't know. So there's definitely people buying it here. At these, even today with the growth tech stocks all being hit, there's definitely these buy orders programs, working today. I think accumulating shares of Tesla through the course of the day. We'll see if it's enough to kind of, if it's not enough to be overshadowed by the sell-off on the growth in tech stocks in general. But it seems to be, I'm pretty happy with the, the share movement today. But I think your earnings model here, Matt, is really it's really a good backstop for all of us Tesla bulls to kind of see fundamentally like what are the pillars of Tesla stock, and these numbers that you kind of show really help, and James Stevenson and others I think really help us kind of understand that like, hey, Tesla is not some growth tech stock that should get cut in half. It could get cut in half. Anything could get,
Yeah.
but there's really a backstop fundamentally for the PE to become like a value stock pretty soon if it gets cut in half too much. Like it's already approaching Amazon territory, and then
Yeah.
yeah, if the stock was cut in half, it'd be like valued almost, it would be approaching Apple stock valuation territory in terms of PE. Like so, and it's growing,
Right.
70% year over year. It's not growing 20%. It's insane. So, and like you said, 100x return, 100x growth of revenue is entirely possible for Tesla. Doesn't seem possible for Amazon or Apple. I can see them like
Right.
their total addressable market might go up 2x or 3x possibly in 5 years, but it can't go up 10x or 20x in 5 years like Tesla total addressable market that it reaches. Yeah.
Yeah, and obviously it's not going to do that entirely on the back of like automotive hardware sales only. To get to 100x increase in revenue, that there'd have to be a lot of things that go right to achieve that, and it would take a
Yeah.
long time. But
Yeah.
the point is, the total addressable market, or like the top line, optionality or the upside optionality is much larger for Tesla than it is for the other Terra cap companies out there.
Yeah. Yeah. And one thing I think that's really interesting, the biggest variable I see, I don't know, tell me if you're right, what you think, but from all your inputs, Matt, you have a lot of good you got to assume things. You don't know a lot of things, so you got to make assumptions on things. But perhaps one of the hardest ones to assume that is also perhaps I think the most important assumption is the price increase ratio. Like how many of the deliveries this quarter uh, had the price increase built into them, as from the orders being made after how many price increases of the Model 3 or Model Y. So there was close to 300,000 Model 3s and Ys delivered in the US. Probably probably would have been over 100,000, I would imagine. I don't know, but there's been substantial price increases like we've talked about. So that's just money on top right there, like the $5,000 price increase, or I think it's increased several times. But if someone really had
Mhm.
great analysis of that and could like have a good,
Yeah,
estimate of like this is the average
it's
price increase. Yeah.
it's tricky to do. And I actually used to do a build up like that. The reason I kind of abandoned it is because you can't ever go back and quality check your assumptions.
Mm,
So like, if you have assumptions and like what the mix shift is of like long range versus all wheel drive, you can have very reasonable projections, but if you're wrong in a meaningful way in any given quarter, you may have no idea why you're wrong. So
mm,
it's hard to go back and quality check that, at least for me. James Stevenson does do it that way, and like he's obviously done great work, so I'm not trying in any way to kind of denigrate that approach, but I've just found for me it's hard to really go back through a high level of detail with that many variables and get it
yeah.
accurate in a way that you can kind of duplicate going forward. But I
Yeah.
do think, based on the comments from Martin Vieca of like price increases really coming through this quarter, and the fact that we didn't really see ASP increase the last couple quarters the way you thought, or the way you might otherwise think you would see, seems likely to me that Q4 will see more of those price increases kind of flow
Yeah.
through. But mix shift could dampen that to a certain extent. So
Yeah.
you may not necessarily see average ASP increase, but what you should definitely see is margins increase as
Hmm.
those price increases take effect.
Yeah. Yeah. Interesting. Um, all right. So, I mean, I think we covered a lot of stuff. Why don't we just go to like, unless there's anything else you wanted to bring up, we can just go to the Q&A portion and just go bang through as many questions as we can for the next 30 minutes of, our audience. If that, does that make
Yeah, let's
sense,
do
Matt?
it.
Okay.
Yep.
All right. So we'll wait for Alec to post some questions here. First question from Alex B. What's your Tesla option strategy for the year ahead, considering uncertain monetary environment? Yeah, that's sort of what we talked about a little bit at the beginning. The uncertain monetary environment or uncertain inflation expectations kind of thing. with that uncertainty of the growth in tech stocks, uh, environment, we're not really buying new call options at this point. We just feel um, there's a lot of risk. If the growth in tech stocks are going to kind of go back and forth a lot, you really have to pick your time. Maybe if the stock goes down, 20 or 30% from highs again at some point, maybe we'd consider it. That's the time, I think, is when it's come down substantially. Um, but it just doesn't seem appealing to us to buy, new call option, medium term, long term call options when the stock is already kind of near its high. I mean, it could work out, but we're already positioned well with some long-term options we bought in the 700s, and we sold a bunch of put options when it was around 600 or 700. We've talked about that in the past. We sold a bunch of long-term, deep in the money put options that are now out of the money, but we're waiting. We're just collecting that premium over time. So, options are tricky with Tesla. It's like the biggest game in town, but it doesn't seem as an easy win like it used to. Like back 5 years ago, 3 years ago, you could make a lot of money, but from 2013 to 2019, you made no money. Almost, it was hard to make money trading Tesla options too. So you had a 6 year window where I was losing money, for example, personally trying to buy call options, and finally it really hit. Matt and I think personally both did really well in 2019 or 2020 buying call options that did really well. So you just don't know. It's just very risky. The stock is the safe thing to own long term. I don't know, Matt, anything you want to add?
Yeah. I generally don't like to discuss publicly individual call options just because, I think there's a lot of
Yeah.
like personal, like how much can you afford to lose and what's your kind of mental state to handle losing everything. I think a lot of that plays into using options. So, if we're coy around talking about options, I think it's not because we don't do it or anything like that necessarily, but a lot of the reason is just that we don't want to recommend something so risky to the kind of general public.
Yeah.
I do think there's a lot of uncertainty. Options prices have gone up quite a bit in the last couple of months. So I agree with everything that you just said, Emmett. They're not as attractive as they used to be, but yeah, we did layer into a lot of things in the fund in the last year and even more recently that I feel very happy about kind of the way that we're positioned. So maybe I just leave it at that.
Yeah. One more note on that real quick is I would say if you're sort of a gambler and you typically you go to Las Vegas once in a while or something like that, let's say you were going to go to Las Vegas every few years or every X amount of time and you saved up a certain amount of budget for that gambling to Las Vegas. Let's say your next trip to Las Vegas was like you saved up $10,000 somehow and you were expecting to just gamble it away at Las Vegas and probably lose it all. Well, I would not be opposed to just redirect that to Tesla short-term options instead. Like just gamble that $10,000 of Tesla short-term options. You probably would lose it, but there's a chance you might win a lot of money with it too. So it's sort of like a gambling. You have to have that mindset, like, hey, I'm going to lose. I probably could lose everything I'm apportioning to these Tesla options, especially short-term options, and just be prepared for that. Just similar to how you go to Las Vegas, you're prepared to lose whatever amount of money you were going to gamble with. So anyway, next question, yeah. From Johnny Lou, is there a good way to properly track how much of the recognized deferred revenue is due to full self-driving? What do you think, Matt?
They do. I've spent a lot of time kind of like buried in the 10Q trying to track this. Like I think at one point I spent like 3 days in a row trying to map this and figure out like based on the increases of the deferred revenue balance, like what does that mean about the amount of new deferred revenue that was added, and then like what do you assume about the amount that's related to like superchargers and other things not related to full self-driving. And the short answer is there's not a good way to do it. So where I've ended up personally, just based on all the time that I've spent doing this and kind of listening to the little hints that Elon and Martin and Zach have dropped over the years and tracking those very closely over time. I'm currently expecting that around 58% of all full self-driving revenue globally is classified or is immediately recognizable. So then if you take, the remaining 42% and you assume a certain take rate for full self-driving and you kind of run that math quarter after quarter, then you can calculate a deferred revenue balance. So like for Q4, my estimate based on doing all that is that the deferred revenue balance at the end of Q4 is $1.75 billion. So it's a good chunk of the total deferred revenue balance on Tesla's balance sheet, but it's definitely not all of it. And I could be wrong on that. But that's 1.7 billion that's going to drop to the bottom line at some point.
Yeah, that's a
and
big
then
number.
you're going to have higher margins going forward because you'll be recognizing 100% rather than 58% of that $10,000 per FSD sale. So it's like these are the sorts of like details that I don't see many of the Wall Street analysts doing. That is like this another kind of hidden catalyst that's right in plain sight. It's going to happen.
Yeah. From Anthony Bentol, have you guys studied Ford? Is their debt gonna ultimately take them out? I think it's funny you say that. I know, Matt, you've looked at it a little bit. It's very complicated, though, right? I mean, it's not simple, right?
It is. So we had a bit of a theory that we were trying to chase down for a while, that a lot of Fords and the other OEMs, but Ford in particular, their cash flow generation and earnings were largely kind of backstopped by used car sales, and that if those collapsed, particularly for ICE vehicles, which seems like a reasonable thesis, then that could ultimately have a bad impact on cash flows and debt, and could lead to bankruptcy. I spent a lot of time trying to tie used car prices to Ford's financials and like test that out, and ultimately I couldn't find a reliable way of doing that. But I will say I spent enough time in Ford's balance sheet to feel really uncomfortable with the level of debt they have. It's like 140 billion, I think, somewhere in that neighborhood. Let me check it up here. Yeah, 100. Oh, 100. It's come down a little bit recently. 117 billion of total debt that Ford has. A lot of it is short term, and related to their operating cash flows. It's like it certainly is teetering. Ford in particular didn't go through bankruptcy in 2008 like GM did. So GM got kind of like a cleaned up balance sheet coming out of the Great Recession, which Ford did not have that benefit of. So I do think if there was some sort of significant either decrease in used car prices or new car sales, or some sort of market crash that hurts auto sales, Ford would probably be the most prone to a bad outcome. I think.
Interesting. Yeah, and their stock's gone up a lot in the last years. In 2021, it went up very significantly, like over 100%.
They're up 12% today. I don't know what the news is, but
what?
I'm trying to
Oh yeah, look at that. Oh my gosh. Yeah, I don't know why. Production, they doubled their production goal for the F-150 electric pickup truck from 10,000 to 20,000 trucks.
I saw that, but like, surely that can't be driving the stock up 12%.
Yeah, that's apparently what it is. No, it's really from like 75,000 to 150,000 or something. That's they doubled
but
their
that was
goal.
their goal. I think they only increased their production from like 10 to 20 or 20 to 40 or something like that. It was like, okay, if that's the benchmark, then Tesla should be up like 800% based on their Q4.
Yeah.
And like, I don't know. I live in Michigan. I've got a lot of friends that work for Ford. I really want them to do well. I'm just trying to, I just call it like I see it, and I don't think they're well positioned right now.
No, no one can be. It seems like there's no way to well position yourself against Tesla. They just innovate too fast or too far ahead. They get the battery supply locked up. There's no chance. I mean, the only thing they can do is try to join Tesla somehow, maybe invest whatever balance sheet they can in Tesla stock. I don't know, but there's really no way. I don't see any of these other automakers, being comparable to Tesla in the future. So,
well, they invested in Rivian, right? And so like,
yeah,
their best operational achievement so far is Rivian's, listing. Like, they're going to have this huge write up in their Q4 print to mark up that investment. That's going to be a huge one-time gain that they're going to have on their books. So that's I mean, that legitimately is worth something, and at least until it's not. So
then it'll be a markdown. Yeah. So, all right. Next question. Let's see here from Mike Arts. Question: if both Austin and Berlin go online this quarter, how do the new fixed costs of those facilities flow through Tesla's financials? I mean, I don't. My hunch is that there's kind of a cost to ramping up a factory. I think they were able to minimize that to a large degree with Shanghai. I'm not sure, because the cost of labor is so efficient there and such. I'm not sure what the cost of labor, how much of a part of the ramp that is, to be honest, how automated Tesla is versus labor, how much labor they're using, and what that cost of, so I don't know. I'll leave it to you, Matt. I think it'll be some amount. I just don't know if it'll be negligible or substantial. What do you think, Matt?
I think it's not going to be drastic. I mean, like if you, I did the math on this for Shanghai a couple of years ago, but if you think of like let's say, I probably can't do all this in my head, but like if you assume it's like $5 billion between Berlin and Austin that will kind of run through, or that will be listed as PP&E this quarter, and then you amortize that over say 10 years, you can come up with like a depreciation impact, and then you say, okay, you've got all these other fixed costs in there, and that's going to drag down your gross margins a little bit. Like that will certainly have an impact, and I think we've talked about that before also, that like Q4 is probably going to be a local high for automotive gross margins, while these other until these other plants ramp up more drastically. So yeah, I'm assuming I think a 4% decrease in gross margin, like the core manufacturing gross margin in Q1, to kind of account for that inefficient ramp up. And I think that's a reasonable assumption. And so I think as long as you're kind of accounting for margins to not just continue to go up like 1% every quarter without really thinking about it, that's not a good assumption.
Yeah.
There will be some impact, but it'll probably be a steep decrease, and then it'll creep back upward over time.
From Patrick Kodua, question: what's your thoughts on Tony Seba's prediction that access to robotaxis will reduce demand for individual car ownership? Would this jeopardize demand needed for Tesla's 20 million year cars per year target? This is something ARK Invest has talked about as well, and lots of folks. I honestly have not followed Tony Seba much. I know a lot of people talk about him, but this prediction I've seen by many folks. This is something we've talked about. I don't think it jeopardizes Tesla's demand needed for Tesla's 20 million per year's target. Honestly, I think Tesla will be producing the best vehicles, best cars, best autonomous vehicles at that time. And I think right now, what do we sell? Like a total globally, is it like 100 million cars globally are sold a year or something like that? I think it's something like in that neighborhood. So 20 million, I don't see that getting more than cut in half, even if everything becomes auto robotaxi, quickly. And I can see Tesla taking a large percentage, and there's going to be much more businesses, much more use cases for these robo taxis in 2030 or whatnot. It's not just going to be driving people, you'll be driving packages, logistics. There's just going to be a whole new industries built on top of the robo taxi demand. I could see Tesla just delivering and producing as many cars as they can possibly make, and they've just put 20 million as kind of their benchmark target. But I don't think they're going to have a demand problem. What do you think,
Yeah,
Matt?
like the 20, I was trying to find the total global fleet, and I don't remember exactly how big that is, but even if you were to snap your
It's like
fingers
a billion or 2 billion, something like. It's like
yeah,
a billion or
it's
2 billion cars, I think.
yeah, so let's say it's a billion, just for argument's sake.
Yeah.
Then that would take 50 years for Tesla to reach to kind of replace every single one of those cars. And within that time frame, within 50 years, that's not like the
Yeah.
cars that you produce at the beginning of that period would need to be replaced again. So like
Yeah.
the 20 million a year is not enough, even if you're assuming like a 3 times higher utilization rate. So instead of replacing the fleet every 10 years, I think it is right now, maybe you need to replace it every 3 years going forward, just because utilization is higher. So, per year sales will ultimately decrease from, I don't know what it is, say 100 million to like, what would that be? Like 30, 33 or something like that. And those numbers must not be quite right, but essentially it would take so long just to replace the existing fleet. And then even if, they do replace that existing fleet, that worldwide fleet will continue to need to be replenished over time. So I don't think I think you need to distinguish between reduced demand for individual car ownership, which I do think that's a legitimate outcome, maybe in 5 years or whenever robotaxis, probably longer than 5 years, honestly. But whenever robotaxis have like wide penetration, that could be a reasonable outcome. But then it will be natural for fleet operators to be buying, enough vehicles to kind of make up that slack in demand. And this is like a very like great problem to have, right? Like, okay,
Yeah.
let's say this thesis is right and they can only sell like 10 million a year, but they're also operating like a robotaxi fleet of
Yeah.
like 80 million units. It's like, who cares
Yeah.
at that point? Like, that's the best
Yeah.
possible outcome. Like,
Yeah.
so
And they're
it,
selling, and they're also making money on all kinds of software margins. There's going to be so many new
yeah,
business cases. Like that's probably going to be one of the least. The actual selling of the hardware car is probably going to be one of the smaller portions of their revenue by that time, I would imagine.
yeah, for sure.
So from Rob Womack, regarding SX deliveries, do you think the slow growth was soft demand, supply chain issues, or just difficulties ramping? Yeah, that's a great question. I'm also curious why there's such a slow growth. For the X deliveries, the demand is out the roof. Like you try to put a new order for Model X now, you have over a year wait. So I don't know what the deal is there. If they're just, I don't think it could be supply chain issues. I just think it's just not prioritizing so much. Like they want to build great quality S's and X's, of course. So that's a priority. But in terms of ramping up, supply chains and production, efforts, I think that's maybe a low priority relative to the 3 and the Y. So that's my suspicion. And they're fine keeping I think they're fine making it a long wait for the S and X. It makes it a more, you know, almost more of like a status, not a status symbol, but maybe just like more desirable if the wait is even longer. And you're like, oh, you got an S. Well, I heard the wait's like a year. I want to get one, but the wait's too, it makes people more desire it more. And that's their highest end product. I kind of suspect that maybe they're fine with just letting that play out for their top end products. Without having to prioritize it and prioritizing all their efforts on the 3 and the Y ramp ups. But I don't know. What do you think, Matt? Why do you think it's
I
slow
guess
growth?
I wasn't really that surprised with it, to be honest with you. I mean, I
Mm,
think the clearly they were retooling the S and X lines for a while, as they had done a bit earlier. This is really the first quarter where the refreshed X has been selling in significant numbers. So the fact that it's slightly slow to ramp up is not a huge surprise to me. So I would
mm.
expect those increase going forward. But I don't know. Ultimately, it's like, even if I'm wrong and this is like a legitimate supply chain issue and they can't get S and X deliveries, it's like it doesn't
Yeah,
really matter that much in my mind. It's
yeah,
like a nice halo thing, but
yeah.
it doesn't drive the stock or the financials.
Yeah, I remember a few years ago, one of the quarterly earnings calls, or a couple of them maybe, someone asked Elon about, when all they were producing was the S and X. This is before the Model 3 even came, they were working on it. Maybe they released the specs or something, but they hadn't produced it yet or something. And everyone just looked at the S and X delivery numbers every quarter. Oh, they sold 25,000 or whatever, and it was like, that's big. Maybe look at the 50,000 one day or something. That'd be awesome. And some analysts asked Elon like something to the effect of like, what do you see for the S and X long term? Where do you think the volume will be? And he answered with something like, the S and X is like an afterthought. That won't matter. It's all going to be about the Model 3. That's going to be we got to focus on that. And at that time, it blew my mind because I'm like, well, the S and X is such an expensive product. It's, 100,000 a year. That's great revenue. Are you going to just throw that away and not care about it? And it kind of like blew my mind, but I thought about it and now it's playing out like the 3 and the Y, are, 10 times now they're 30 times more volume than deliveries than the S and the X combined. It's crazy.
Yeah.
So maybe
But
that'll
back
same will
then
happen with
you
Model 2 even one day. Who knows?
back then you would have thought, okay, well they'll never have like 30% gross margins
Yeah.
once, S and X is a small percentage of the fleet or of the new
Yeah.
car sales. It's
You
like
wouldn't imagine that. Yeah.
that was like the given logic, which was clearly wrong. But
Yeah.
it's just true. I mean, the way they've been able to scale so profitably is just like tremendously impressive.
Yeah. Yeah. Manufacturing is their advantage, it seems. So from Mav Ace, question, thoughts on Rocket Lab price action? Yeah. Rocket Lab's kind of been moving in tandem with the growth tech stocks lately. I wasn't necessarily anticipating that because it's not part of like ARK's fund, and we talk about it. but I don't see Rocket Lab in the same kind of class. It's kind of its own unique enigma. It's sort of like buying a piece of a startup company or an early stage company that is going to take years to kind of play out. That's how I see it. It's not going to, wow too many people with revenues in the next year or two or anything. It's going to be a few years, but um, yeah, I mean, Rocket Lab's been hovering around $12. They had that warrant redemption, which seemed to make a hit on the stock. So I think a lot of short-term speculators are probably tired of it and hopefully getting crowded out of it. But that hopefully there's enough long-term owners of the stock that it'll stabilize and creep back up over time. But Matt and I are certainly more long-term uh, hold. I think with our study on it, we're thinking much more long-term with Rocket Lab, and when the market realizes the potential of Rocket Lab as a space industry mainstay or not is to be determined. So that's when the stock price could change to the upside. We're thinking, but that's not a guarantee it'll happen this year. Even in 2022, it could be longer. What do you think, Matt?
Yeah, I mean, just in contrast to the first part of our conversation today, like where Tesla's PE ratio acts as like a backstop to price in some way,
Yeah,
um, or at least can in theory. Like that's not the case for Rocket Lab. You know, like it's trading
yeah.
like
It's like the
earnings are
opposite.
obviously
Yeah,
negative. Yeah, like revenue multiples are like really high. So it's going to be almost impossible to kind of forecast short term price movement. So we don't like
yeah,
mess around with short term options plays with Rocket Lab. So it's really just like a long term buy and hold for the most part.
yeah,
Um, I think just because like there's no great way to think of like short term catalysts. I
yeah,
know they can have some good launches and that could help, but not really. Like it's not going to triple
yeah,
based on like having
yeah,
like solid launches in
yeah.
2022.
Yeah, it's really just kind of a way to buy into the overall space industry that we feel is a very good value investment for the rest of the decade. Relative to like buying into SpaceX at 100 billion plus valuation when it's privately traded only and it's not liquid. For example, this is publicly traded. It's got a $5 or $6 billion valuation. So we just feel like it's a really good play, pure play for getting good exposure to the space industry. We see it as a major player in the future in the space industry. So Arnold Oberleader, Bitcoin on Metro Miles balance sheet. Any opinion and general price action on Lemonade? Nancy Pelosi Roblox calls. Have you seen it? Can the ramp of Berlin and Austin hurt Tesla margin? There's a few questions here. I have not seen the Bitcoin on Metro Miles balance sheet. Doesn't surprise me. Maybe it does a little bit, but I don't know how much Bitcoin. Can't be that much, I would imagine.
Mhm.
Um, and Lemonade, yeah, Lemonade's just been floating at lows here. Well, $38.69 right now. Wow. So that's pretty crazy. I mean, Lemonade's at a 2.3 billion valuation, 2.4 billion market cap right now. So it just seems it's a binary outcome play that we've talked about. It's either gonna dwindle away and be bought for pennies, acquired eventually. But I think that event wouldn't happen for a couple years at the earliest, or 18 months maybe at the earliest if they continued to dwindle. But I think it would be more like 2 or 3 years. They have enough money on their balance sheet to survive for a few years, it seems like. And the next couple quarters, I think, will really determine if Lemonade is a more significant threat to the insurance industry or not, and can really grow and support itself. So it's a binary outcome. Either goes down or it goes up, obviously. And if it goes up, it could go up, a lot. So you just have to kind of put your own probability on which outcome it will be, I guess. And the next quarters will determine that. I think more so. We'll have a better probability idea.
Yeah, the upsides seem more asymmetric from here though, which is a good thing.
Yes,
I think.
yeah, yeah. And the Nancy Pelosi Roblox calls, I have not seen that. She's getting hurt today. Anyone who owns Roblox calls getting hurt today. We can speak from experience. So yeah, Roblox call. I mean, Roblox is huge. We've been speculating that maybe there's going to be a nice surprise for bookings in December. We'll see. They might not release that type of metric until their earnings report in February. We'll see though. and by then market might not care as much. So, but we're still bullish on Roblox long term, medium and long term. But it's definitely one of those growth tech speculative stocks. So it's gonna be influenced by the wind of the macro markets heavily. And can the ramp of Berlin Austin hurt Tesla margins? I think we sort of answered that earlier, right, Matt? So
Yeah.
yeah.
Yeah. Now, and he did clarify in the comments there's $1 million of Bitcoin on the Metro Mile balance sheet. So, I mean, that's to me, that's kind of a non-issue. Like, whether you're talking about Lemonade or Bitcoin in general, it's like I think for Bitcoin to get wider adoption among S&P companies, it's going to be the larger companies taking initiative that would I think be more impactful. But a small company like Metro Mile doesn't necessarily surprise me. Wouldn't surprise me if Lemonade disposed of that, just not wanting to kind of get in the mix. But if they held it, that'd be fine too. I don't think it's good or bad either way, personally.
Yeah. Yeah. Next question. Let's see. From Messi L. With all natural resources available in one country and a major producer of hydroelectricity, would Canada not be a possible location for the next gigafactory? That's interesting. I don't know. I mean, if Canada, I don't know Canada's export import laws or tariffs or whatnot. I don't see anyone else. I don't know. I don't know enough about Canada, to be honest. That's something maybe we should study up on. But I'm not sure. Do you have any opinion, Matt?
I think the more important variable is how close are they to centers of demand, not how cheap is their renewable energy cost. I think they'd rather ship in lithium from somewhere else and build their own solar panels to fuel to power the factory, and save on like $2,000 per unit of like shipping costs. Like to me, I think that's the more impactful thinking that Elon has going through his mind. So in that case, I'm not sure where the next kind of unmet pockets of demand will come from. But it doesn't seem likely to me that it would be Canada, especially when you already have 2 North American factories. It seems like it would most likely be somewhere else.
Yeah, I would agree. I haven't seen any other major global companies build factories recently in Canada. I could be wrong, and I haven't heard of any courting by Canadian governments for Tesla to set up production there either. All right, let's take one more question here. Let's see here. It's close to 10:30 Pacific time. So from Curtis Johnson, if robotaxis are profitable and Tesla has billions banked for operations, what incentive does Tesla have to keep selling to private owners? That's a really good question. And I think the same thing actually about the Tesla bot. I don't, that when the Tesla bot comes out, they're going to have tons of money already, banked lots of money for operations. I wouldn't be surprised if they just kind of lend out or lease these bots and instead of selling them flat out to people. But for the robo taxis, that's sort of like a bot, but a car, and so over time, I would agree that there may still be an option just because of inertia of the business model. Maybe they'll still sell Tesla cars, but maybe they'll be more expensive, the new ones, or maybe the used Tesla cars will go up in price too. But I think there's a good chance Tesla maybe has their own kind of fleet, or they could just outsource the fleet operations to other businesses, let other small businesses get set up for the purpose of fleet operations, like the guy Florian, who you've interviewed in the past and we've talked to in Europe, is sort of in early stages of doing. So yeah, it's a good question. What do you think, Matt?
Yeah, I mean, I agree with everything that you said. I think the incentives won't only be financial. So, for example, like Tesla couldn't, I don't think Tesla would, let's say deep into the future, they're producing 20 million a year and they're all for robotaxi applications. I don't think Tesla's going to be operating every single one of those 20 million, vehicles. And then like 5 years down the road, that's a fleet of 100 million vehicles that are all owned by Tesla. I just think that the scaling of O&M required for that, and like like having operations in such disparate locations would be very difficult to kind of scale up. So I think they'll probably prioritize selling, FSD to robotaxi operators, because that will be, the highest way to, or the highest margin use of, that product that's rolling off their factory lines. And I think they probably will operate some of those, but I think they'll lean on, private operators like Florian and like Hertz, and like I think you and I each have Cybertruck reservations, and I'm still thinking of that as a real option. Where I don't know, 5 years down the road, I might very well be operating a fleet of robotaxis, a small fleet just on the side. Hire somebody and handle that. So I think that's the way it's going to pan out. It's going to be more helpful because you're going to need like parking and charging and cleaning and like a lot of things that don't necessarily scale up in every small town. For Tesla to have operations to handle that, I think would be difficult.
You know what I think will happen? There could be even like small businesses. You'll see all kinds of new, cool small businesses set up with the purpose of running, autonomous robots as fleets, or whether it's the Tesla bot or the robo taxis. I think it would be cool. It'd be really neat, how you can invest in like real estate investment trusts, REITs in the US. It'd be cool if you could set up like a robot investment trust and people could invest in it.
I saw your Twitter thing on that. It's a good
I
idea.
love that.
Maybe there'll be a good soil
robot investment
trust down the road.
Yeah, we should hire someone to manage setting that up and do that. Maybe we'll talk to our friend Wes Gray, who we interviewed a couple weeks ago. He might have some idea. I mean, he's in the ETF specialty, but real estate investment trusts are probably very different. But this would be similar to a real estate investment trust.
Assets. It's
robot investment trust.
It's not liquid.
Yeah, but I would think international investors I think they can invest in U.S. exchange traded REITs. I think so. I would think like non-U.S. investors. I think a lot of them can't invest in U.S. ETFs, maybe, but I think in robot investment trust, if it's similar to a setup structured similar to a real estate investment trust, maybe it could be international. We can get international investment that way too. Who knows? We'll have to look into that side project. We'll see. Maybe we'll get Alec to try to look into it with us or something. So I don't know. Interesting ideas. So someone will do it if we don't do it, right? That's what Elon said about the bot. So
for sure.
We'll see.
Yeah. All right. Well, the technology to get there though.
Need the technology. Yeah. All right. Well, great chatting. Just after 10:30, we try to keep this to an hour. And thanks for all the questions, everyone. Great questions. We'll be here again next Tuesday, same time, same place. And let's see what happens with Tesla stock the rest of today and this week. Exciting times, roller coaster rides, and we'll see you all next week.
Thanks, everyone.